Just when you thought the Fed was now your friend, they cut rates 50 basis points to quote-unquote recalibrate Fed policy. At the same time, Jerome Powell lied to us yesterday and stated that the economy is, quote, doing just fine and there's no reason to suspect a larger risk of a downturn. Well, that's not what FedEx just said. Actually, quite the opposite. FedEx is down 11% in after hours. And here in this video, I will explain why FedEx is one of the most important companies that you need to be watching for in terms of an economic barometer. Because let's face it, the government data that we get from now until the election, really over the past 6 months or so, has not been that accurate. We can speculate to why that is. I don't want to get too, political here on this channel, but the data is not right. The data is incorrect. Even the Fed himself, Jerome Powell, Federal Reserve Chairman of the Fed, said, yeah, the data is not that accurate. Okay, so what's going on with FedEx? FedEx, at least this article reads, FedEx quarterly profit disappoints as demand for speedy delivery wanes. FedEx reported a steep quarterly profit drop and lowered its full-year revenue forecast on Thursday after its customers continued to trade down from speedy, pricey delivery to cheaper, slower options. Oh, but that's not the part that has me a little concerned, or I should say a lot concerned. CEO Raji says industrial demand was softer than expected. Shipments between manufacturers and other companies in that segment are the most profitable for FedEx, which is often seen as a bellwether for the US economy. That's not the most concerning part either, although that is quite concerning. So basically, companies that make things are not shipping as many things. Thus, they're not making as many things, which is a pretty bad sign for the economy and what's going on the ground in real time. Again, we don't get a lot of good data. So companies, that's about the best we're going to get to judge what's happening in the economy. And this is off to a really bad start to start Q3 earnings season. And I did talk about this in the last video. FedEx is important because it is seen as a bellwether for the economy. That's the exact terminology I used that is here in this Reuters article. Basically to say if FedEx is doing bad, then the economy is doing bad. But here is the most alarming part of this article that I'm going to share with you. Get ready for this. Like, brace yourself. This is what the FedEx CEO just said on the conference call. He said, quote, "The magnitude of the Fed rate cuts yesterday signals the weakness of the current environment." Submaranium said, Manium, I don't know if I'm saying his name right, referring to the Federal Reserve's decision to cut interest rates by 0.5 percentage point on Wednesday. So let's get this straight. The CEO of FedEx just said, you guys see just how bad things are. The Fed just cut rates 0.5%. Like, what? What? That's crazy. I mean, for FedEx, that is a company that is very dependent on strong economic activity, to be saying this really just shows the disconnect here. And I think further proves the point that Jerome Powell just flat out lied to us yesterday. The economy is nowhere near as strong as he suggested it was. This is a visual representation of FedEx different segments of their business. This one here is revenue from FedEx Express. This is the higher profit margin portion of FedEx's business. This here, you could see it says Q1 2025 because they're in fiscal year 2025, was 18.3 billion. Okay. Q4 of 2022 was 19.18 billion. This chart, if it's a, let's say, bellwether of the economy, does not look good. There was quite a dramatic decline on a quarter-over-quarter basis, going from 18.79 billion to 18.3 billion. You're not typically expected to see that from a Q2 to a Q3. Now, here are the actual numbers. FedEx reported adjusted earnings per share of $3.60 from sales of $21.6 billion. Wall Street was looking for earnings per share of $4.75 on sales of $21.9 billion. So for EPS, they missed by $1.15, about 25%. That's bad for a company that is a bellwether of the economy. That's not good. And on top line revenue, they missed by about $300 million. A year ago, the company earned $4.55 per share on sales of $21.7 billion. So they're even negative on a year-over-year basis, comparing the same quarter last year to the quarter that we just reported. That is not good. Now, even Wall Street was dead wrong on this. Bank of America analyst Ken Hoekster was ready for some seasonal weakness, reminding investors that FedEx's fiscal first quarter, which spans the summer months, is typically a slower quarter for the company. Hoekster trimmed his earnings estimate ahead of the report to $4.76 a share, from $5.21 a share, reflecting a slowing economy. He wasn't aggressive enough. Yeah, even he was off by well over $1.25 per share. And FedEx now says that sales growth is expected to be a low single-digit percentage increase, like 3% perhaps, or 4%, or maybe even 2% or 1%. It's not looking good. Now, why I specifically bring up FedEx is because obviously they are one of those companies that reports early in the earnings season. They are seen as a bellwether of the economy, okay? That is why FedEx is so important. But I actually don't think the markets are going to care much about FedEx earnings. The markets right now are experiencing what I would call a sugar high from the really unexpected 50 basis point rate cut from the Fed. Out of 120 Bloomberg economists, only 114 of them expected 25 basis points. So only like, what, 6 of them got it correct. So Wall Street was taken by surprise, generally speaking, with the Fed's 50 basis point rate cut. And for whatever reason, the markets tend to believe Jerome Powell. They tend to think the Fed is, for whatever reason, honest with markets. The Fed's mandate is not to be honest with markets. In fact, the Fed is highly incentivized to lie to you when it's advantageous for them to do so to meet their goals of their dual mandate. For an example, it would have made 0 sense for Jerome Powell to come out there and say, we could be in a recessionary environment within a couple of months. We are starting to see some real cracks that are concerning to us. We're monitoring them. We're going to cut 50 basis points. We are prepared to act aggressively as things get worse. Like, if that's the tone we had gotten from Powell, markets would not be at all-time highs right now. We would probably be down 10% already since yesterday. And with the Fed's dual mandate being price stability and maximum employment, the Fed's already accomplished their goals on inflation. They don't want the labor market to roll over too much. And if Jerome Powell was honest with us yesterday, companies would be probably announcing layoffs here very soon, getting ready and preparing for the upcoming recession. That would not have been to Powell's benefit, to be honest, yesterday. So with that said, I do think in the short term, the markets are probably going to react the same way we did in 2007, in which the Fed gave us a 50 basis point rate cut in 2007. And just strangely enough, it was on the same day, September 18th, 2007. Yesterday was September 18th, 2024. Most economic data was in the same kind of ballpark then compared to now. Like, the unemployment rate was about 4.7%. Our unemployment rate was just 4.3%. NFIB investor confidence signals, Michigan consumer sentiment, all of these things were within just a couple of tenths of a percent of each other. Like, the economy then and now, very, very similar. So I think from that standpoint, it can be valuable to look at the past here. And when the Fed cut rates 50 basis points, September 18th, 2007, what happened? Stocks rallied 3% that day. and then ended up going higher by almost 7% in total over the next 3 weeks. But then when markets peaked out, that was it. That was the high of the markets for a couple of years. I mean, markets did not hit a new all-time high again until 2013. Like, do I think that's going to happen again? No. I don't think it's going to take, what, 6 years to hit a new all-time high in the markets, right? I don't think we're going to have another 2007 global financial crisis again, but I think we're in for a problem at the bare minimum, and markets are not priced for that. Even major Wall Street banks like Wells Fargo and JP Morgan, they're like, yeah, we really don't want to chase markets right now because the valuations kind of disconnected from reality. And that's really part of the problem here. Markets are just not priced for economic weakness. We're just not priced for that. So as the economy does weaken, you will see that risk get priced into markets. And that risk getting priced into markets will be painful. Now, it's hard to say what's going to price in this risk. If it's going to be a disappointing earnings season, perhaps. If it's going to be after the election when economic data starts to come in more accurately, that's also going to be an issue coming November, December, January, February of then 2025. But again, I do think in the near term, the markets are going to look past all of this. I think you're going to see a lot of shorts covering. I mean, just go on CNBC and look at like what Wall Street is saying. 90% of the individuals going on CNBC right now are very bullish. That in and of itself is typically when I want to be a little bit more defensive. And ultimately, whether we have a really bad 2025 or not is going to come down to the economy. What happens with the economy if we weaken a little bit, if we weaken a lot, just how we evolve economically speaking. But right now, you're priced for a booming economy for basically ever. Now, here's how I want to trade this. Even though I think there's about an 80% chance of a 20% crash at least over the next 3-6 months in the relative near-term future. I mean, keep in mind, a 20% crash from here would be basically nothing in the grand scope of markets. A 20% crash from here would put the SPY back to about 450, roughly where you were to start 2024. So we're up about 20%. That would basically erase the gains for the year. I don't know if we get that in 2025, but I do think we get some kind of election correction. Perhaps it's 5-7%. 7%, maybe 10%, but I'm not expecting a 20% crash, at least for the next couple of weeks. I think we need to really concisely see the economy weaken, and I firmly think that's not going to happen until after the election. That's why I think November, specifically December's economic data, is going to be looking really bad. January, February, once we start to see the poor numbers from the holiday shopping season, yeah, that's when we're gonna be in a problem. So from that standpoint, I think there is a major risk of a downside crash event. This could be a 30-40+% crash if we ultimately do slip into a recession, again, because markets are not pricing that in. Markets just keep going higher, unwilling to price in any risk. And if we're blindsided by a rapid deterioration in the economy, which is kind of what FedEx said today, that's a problem. Now, at the same time, I do think there's a 20% chance of a soft landing, that maybe the 50 basis point rate cut does help spur some demand, and maybe the economy is not great, but it doesn't get super bad at the same time. In that scenario, I actually think there's risk in sitting out this market. So I think the way you can benefit from that is being in cyclicals and small caps and dividend stocks and in value names, broadly speaking, because those are the areas that are truly not priced for a soft landing. Most of those areas are priced for a recession or a recessionary-like economy. like CVS or Dollar General, some certain healthcare stocks, and really the list goes on and on. Those are the areas that I would want to be invested in markets. That's what I've been saying for months now, but that's also what Tom Lee has started to say as of recent weeks, that you want to be in small caps, in cyclicals, because if we avoid a recession, cyclicals that are cyclical to the economy, and just so you guys know, cyclicals means if the economy does well, cyclicals do well. If the economy does bad, cyclicals do bad. They're cyclical in a circle, cyclical to the economy. They come full circle with the economy, okay? That's the area that you want to be in because they are priced as if there's a good chance of a recession. That's obviously clear in small caps. If you guys have looked at small caps anytime, over the past couple of years, we're still not even at our all-time highs. But I do think ultimately at this point, the best thing you could do for yourself, for your family, for your children, trust me, I'm right there with you. I have 2 kids. The best thing that we could do right now, you could do right now, I could do right now, is to have as much cash available to buy the dip when that big dip does come. And when the Fed fully cuts to neutral, or maybe even lower than neutral, that's when the full capitulation from the Fed comes in. That's when money becomes easy or cheap again, maybe even free again. And that's when stocks will ultimately bottom and start to recover. And for those people that say, rate cuts don't have a lag, I think they do have a lag, but even deeper than that, I think the US consumer has kind of evolved in being more financially conscious, right? Ever since people got stimulus checks and had all this money and they've run out of money and now they're in a, bad situation financially, people are like, okay, when I catch my footing, I'm not going to go out and be financially irresponsible. Unfortunately, the US economy kind of depends on people being financially irresponsible and spending way too much money, going into way too much debt. I don't think we're going back to that anytime soon. After prices have went up so much, it could take many years for people's wages to catch up to the cost of living before people really feel comfortable going out and, getting that new boat or going out and, getting an expensive personal loan or going out and refurbishing their home, unless obviously they were in a good position to begin with. I think the psychology around money has somewhat changed in this country, especially with younger people. That is something that we need to be watching for over the next 6 to 12 months to see if the economy reacts to the Fed's rate cuts. It's kind of like the mortgage market. Rates have been falling from 7.5% down to, I got to quote it, 5.8% in the last, 3 months or so. But yet mortgage applications are not picking up. They're just stalling out at, I should say, record low levels. You are also starting to see more supply of homes coming on the market. Every time I look at Zillow, which is every, 2 days or so, 3 days or so, I see a ton of new homes coming on the market. And eventually that supply and demand could bring down housing prices, and that becomes a negative, a big negative for the economy, because really most families' largest portion of their net worth is in their home. If they're not able to sell their home, that puts a burden on them. If their home values start to go down, that puts a burden on them as well. So unfortunately, I wish I had better news to go over with you here in this video, and I am totally unbiased. There's a chance I'm wrong. I'm probably not. The economy is probably weakening more than we think in real time right now as we speak. FedEx kind of reiterates those concerns that I have. But if I am wrong, I want to be the first one possible out there that flip-flops and goes bullish, because I want to take full advantage of that. Now, I do still have about 50% of my portfolio in cash and about 50% of my portfolio in value, in dividends, in deep value names that are beaten down, that are priced for a recession. So just in case I'm wrong, I'm not just sitting out this market with a ton of cash. I have about 50% of my portfolio in those areas that will have an outsized benefit compared to the S&P. So like if the S&P goes up another 10% from here, let's say, those areas are probably going to go up 20-25%, especially if there's a soft landing. Those areas could go up 100% or more. Like the portfolio could double up with just half of the value of the portfolio in those names. That's kind of the way that I'm looking at it. It's pretty safe portfolio. Like this is like Dollar General, CVS, right? This is some healthcare names, some, quality select small caps. So it's not like I'm taking a lot of risk at the same time. So I think now there is a huge opportunity in those areas because you don't have to take a lot of risk. There is a lot of upside in some of those stocks as long as we do achieve a soft landing, which unfortunately we won't know that until deep into 2025. But then you can also take advantage of having a lot of cash on the sidelines ready to go shopping. So let me know what you think about this information down below in the comment section. Surprisingly to some, this was supposed to be a very short video, but I guess there was a lot that needed to be said here. So hopefully you guys enjoyed it. Let me know what you think down below in the comment section. Have a fantastic rest of your day and night. I will see you in the next one.